From the morning reading, stocks bounced back following Tuesday's sell-off. 6 of 9 sectors moved higher on Tuesday. XLE, XLF, and XLI were the strongest sectors, while XLU was the weakest sector. Oil futures rose $1.45 to close at 41.17. Breadth strengthened compared to the prior session as advancers led 2011 to 964 on the New York Stock Exchange and led 1710 to 850 on the NASDAQ. IWM, the Qs, Spider all bounced following Tuesday's sell-off, recovering a portion of their modest drawdowns. The Spider at 216.18 closed back in its 15-day range between the 215.31 and the 217.65. On the S&P 500 snapshot, a modest bounce. Today, as in yesterday's session, was a mixed day for global equities. In Asia, the Nikkei and the Hang Seng tanked, down 1.88% and down 1.76% on disappointed expectations for fiscal stimulus in Japan. In Europe, the Euro Stoxx 50 ticked up a fractional 0.14%. U.S. equity indices fared a bit better. The Dow snapped a 7-day losing streak with a modest 0.23% advance. The favorite U.S. equity benchmark, the S&P 500, hit a lunch hour high, sold off to bounce off yesterday's closing price in the mid-afternoon, and then closed at its intraday high with a 0.31% gain. The yield on the 10-year note was unchanged at 1.55%. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:44 a.m. Mountain Time, and I'm recording this in preparation for the market day of August the 4th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into that morning report. And today's pretty positive, though very modestly. On all four, the U.S. broad-based indices were up, but they're all up just above scratch. Crude oil's at scratch. Euro is also at scratch. Bonds are up by 1/3%, as is gold. And overseas action, you have China up just above scratch, Hong Kong up about a little over 1/3%, Japan up about 1%, as is Germany. United Kingdom up about 1.5%. In terms of macroeconomic reports for today in the United States of note, you have the weekly unemployment claims and the factory orders and nat gas storage. And looking forward to tomorrow, you have the monthly employment reports. And that looks to be about it, but that's a biggie. So that's a very, very important report, definitely capable of being a market mover. In terms of current volatility conditions, yesterday was a little bit of a bounce back, so volatility ebbed off just a little bit. Short-term VIX down to an 11.3. Skew also still in that barely elevated in cautionary area at a 129. IV percentiles all still single digit, with the S&P at an 8, the Russell at a 3, the NASDAQ at a 4, and the Dow at a 5. Standard deviation moves yesterday, there were none on a close-to-close basis for the 4 U.S. broad-based indices. So obviously you had that across all the markets the day before, but yesterday's bounce back was a smaller move. In terms of the charts, let's go ahead and bounce over there. And we're on the S&P futures charts, and you see we had the little bounce that came down, broke that about 13-day trading range, and kind of tested down here near the former area of resistance, now hopefully turned support, and thus far seem to be coming back into the range. So hard to make too much of this. I mean, you had a little tickle above, a little tickle below, and right back into the range. At this point, I don't suspect that any of it was meaningful other than an attempt by some traders to probe the edges and see if they could get something going. Both were rejected, so we're still left kind of in that neutral zone for the short-term trading of being a range-bound, consolidated market with no clear direction. Let's take a look at the other indices and see if they tell us anything different or new. The Dow, of course, has been in a bit of a slide, and we have this diagonal resistance line that's been painted, and, still have not challenged that in any meaningful way. And I think that's about all we can say. Until that breaks that diagonal resistance, you really haven't done anything in the Dow. We have turned the corner in terms of just having consecutive down days. So that, with yesterday's close, was changed. You have a bit of a hammer formation down there, and so far today that hammer is being confirmed, but it's up against a resistance area and not too many points away, so really haven't said anything of note. In terms of the NASDAQ, of course, has been more positive, and right now looks to be more of a bull flag formation, but I suppose it's trickled out enough to have fired off that bull flag in the overnight session. We'd be much happier to see that confirmed with the price action of the cash market participants. And then the Russell also had a reversal yesterday, and a pretty good reversal. It'd be a piercing line where you have action from the day before, nice big body, and then this reversal body, and it covered more than half of the prior body, so pretty good bullish reversal signal in there. So right now, frankly, we're looking probably to set up something of a, I guess we could call a flag pattern. Really, the stronger signal would be to take something that breaks out above this action here, because while we did slide up, most of this is pretty much sideways, and these incremental highs were just barely so. Now, I'll give it that many bull markets are just incremental increases one day on another, and you just edge up. But I'd like to probably see a clearing of this area. You could take a small position if you're a NASDAQ player, a small position with a breakout above this pattern here, and then add to it once you break the highs. You probably also would want to take some of your position off as you come into this area before you add back in. So pretty weak pattern right there. I wouldn't get too excited about any of those trading possibilities at this point. In terms of bonds, let's see what bonds are doing. Bonds are up, and they're up on a day when the market is relatively going nowhere from the Globex view. So we'll see if that has some sort of meaning. Right now, it just seems to be, inside a trading range of itself, and not particularly indicative of anything larger. In terms of the other safe haven asset, here's gold, and gold seems to be up against its area of resistance, and it's chattering just below that, with no clear breakout yet, but also clearly, not breaking down. The expectation is that gold would eventually break up. Might have to be patient for that to happen, though. In terms of crude oil, of course, had this awful breakdown from the wedge pattern. It broke down from the cloud and really broke hard, and then had a reversal pattern here in recent days, and we haven't seen much follow through. Obviously, once you break down in a pattern like that, there's all kinds of overhead resistance now that has to be built back through, and that can be tough slogging. You're now below the cloud. You're below all the key moving average lines. I mean, this isn't clear air anymore. There's a lot of congestion and resistance to any move higher in crude oil that's now built in by this breakdown. So we'll see where that goes. And then let's go to the VIX. VIX is still chattering down here in this very low volatility area. In the yesterday's action, you see it started coming down from the prior, a little bit of a pop, but nothing, significant, and has pretty much erased that action since. So don't get too excited about any of these moves on the indices or bonds, gold, or anything like that right now until we see them start to break out of their respective resistance or support zones. They're all pretty much in a sideways consolidation pattern. Now, the monthly employment report might be the impetus to get us going. That is considered one of the big four macroeconomic reports. So that might be enough to move these markets off their kind of neutral positions. Let's go ahead and go back to our daily report. And daily report is pretty much status quo. Intermediate term phase opinions, still a bullish phase 3. The bull flagville is what we'd call that. In terms of the three market timing signals, there are some changes here. The first one, though, from IBD, that mechanical signal is still bullish, confirmed uptrend. The second one, GMI index, still a 5 out of 6. That buy signal has been in place for over a month now. The change came in on the third one. The stock charts decision point scoreboard saw some deterioration in the short term. And our short-term signals, we now have two new bearish signals on the Dow and the S&P 500. So this gives us the start of potentially a deterioration of the quality of that signal. And then that, of course, is up against what's been here all along for recent weeks. It's been this mixed signal in the long term. So definitely getting a bit of a mixed signal coming from one of our three market timing signals, and you want to pay attention to that. And what we look for, of course, is change and then rate of change. And as we move through the daily report each day, we're always looking for these incremental changes and what are they pointing to, and are they starting to get support from other areas of the daily report. So these two signals, they're important to us in that they're part of our market timing signal system, and they're starting to call into some question, the recent bull move and maybe be setting up for something of a pullback. Now, we have to wait and see if we build on this signal and we start to see this ripple through the different indices and through the different time frames. And is this the start of something, or is this just something of a little wobble and then we turn green again in a few days? In terms of position sizing opinions, no wobbling here. They're still both at 100%. Intermediate term market posture, also no wobbles here. They're all four still very severely strong bulls, and they're all supported by bullish sentiment lines. As long as we're up over 80 in those, they're going to be considered severely strong bulls. Strength of the trend, very strong. Hedge warning status remains at 0+ normal with some cautionary aspects. In terms of strategy opinions, all three of these are giving permission for the initiation of new positions to novice traders. I did read one thing yesterday that I thought was kind of interesting, and it was just kind of pointing out to the fact that when you're up against this wall of resistance from the sideways patterns that we've been in across the various indices, it's very difficult to initiate new positions. And I have to agree with that. We have been talking about scaling in, if you get a particular chart that's doing something, maybe take action on that chart, but don't be piling tons of new capital in at these high levels. Wait for some sort of confirmation that you're getting a breakout, and then add incrementally as you gain confidence in those moves. It may seem that you're always a bit late to the party, but this is not an easy market. This is not a healthy bull market, and we do not have a healthy bull trend on the intermediate where we have a whole series of higher highs and higher lows, and every now and then you get a little quake with a bit of a pullback and that kind of nature. That's not this market. That's not the market of 2015 or 2016. That better describes the market of some earlier years in this bull market. We're 7 years plus into this bull market, and it becomes increasingly difficult when you're in extremely mature bull markets to get trend-like moves over significant periods of time. So especially when you're up against these areas of resistance, very difficult to be adding lots of positions. In terms of specific warning areas, we added one. We've had these 2 low-grade warnings that have been persistent over recent trading sessions. Well, now the VIX is in a daily squeeze. So what that means is that at some point, and this can persist for a period of time, at some point, though, that squeeze is going to fire and we'll see a sharp increase in volatility. So just one more sign adding to our warnings of a potential negative move for equities. And trend, this area, everything is certainly still very strong, very bullish. But in the intermarket risk aversion indicators, we now have 4 of the 5 as risk off, and the last one is rolling over. So this has been definitely a warning of deteriorating conditions, from the prior action that we had. So when you take all this together and you take that one market timing signal change that we got in the short term of the Dow and the S&P, it does call into some question just how strong the current bull is, and that we might be seeing some deterioration starting to set up. In terms of sentiment, we're still in the upper quartile. In fact, we actually increased yesterday, so we're now at an 81. Sector specific, you notice the short to intermediate term market postures in most of the sectors now, all but 3, have deteriorated to the point that they're at best neutral. So again, more evidence that our market has become, more questionable in recent trading. Healthcare, financials, and technology are the 3 sectors that are holding up. And I'd argue that that's kind of an odd set to be the 3 that are holding up with everybody else in neutral and down. Healthcare has been consistently doing well of late. Financials, on the expectation of the interest rates, are expected to be doing better because they benefit in this kind of an environment. And then also technology, they've had a number of large NASDAQ-oriented, technology-oriented companies that have had good earnings. So that probably is the stories that are going on here. So this may be kind of individual stories and not so much a sign of a larger macroeconomic kind of situation. We'll have to see if we get any consistency. One of the things about having this kind of sideways, largely sideways market in the big picture is that you get quick oscillations in who's in favor today is not in favor tomorrow, and there's no consistency as they flip-flop back and forth for any kind of persistent amount of time at all. Though on the day yesterday, the percent change, certainly energy, financials, industrials, they were the ones on top. The consumer staples, utilities, some of our stubs were the worst performers yesterday. So it did seem in some ways that there was money coming out of the more conservative low beta areas and rotating into higher beta areas. But you see on the 5-day, the 1 week rolling basis that, the ones that have been positive have been barely positive over that session. So definitely something of a deterioration of conditions. So that's about 20 minutes. So let's go ahead and roll this thing up and get published. Disclaimers as always, do not take this lightly. They are here for a reason. Hit the pause button if you need more time to review the disclaimers. And then, of course, at the bottom, note the hyperlink that takes you to the full set of disclosures. We'll see you back here for the next market preview session from Falcon Global. In the meantime, manage that risk. If you take care of your risk profile, you'll find that your profits will accumulate very, very consistently. Good trading.